Good afternoon, everyone. My name is Sven Borho. I'm portfolio manager of the Worldwide Healthcare Trust. And on behalf of OrbiMed, I want to welcome all of our shareholders, stakeholders, and most importantly, all our friends here. And it's really great to be here. Seeing so many familiar faces, over the years was really sad to miss that personal contact with our shareholders over the past 2 years. Now, I have been calling for the end of the pandemic, I think, on our Zoom meetings for 2 years in a row. And I was wrong, I think, those 2 years. But what I was right about was that our sector, healthcare industry, has really been the key driver behind bringing this pandemic to an end. What I think our industry, what the healthcare trusts invest in, what they have contributed here has been tremendous with the vaccines, with the therapeutic antivirals, with all of the diagnostics. So I'm really proud of our sector, really proud to be investing into this sector. And I hope this is the last time I have to mention COVID actually at an annual meeting. And it will be the last time actually for today. So what I'm going to do today is I'm going to give a brief update on OrbiMed. I'm going to talk about the last fiscal year, our performance, which was a challenging year for sure. And then most importantly, I'm talking about the outlook and the investment themes. But, I do want to take a little bit of time to talk about a very important topic. Today is a sad day because we have to say goodbye to an incredible chairman of the Worldwide Healthcare Trust, Sir Martin Smith. During the history of the fund, 27 years, we had 3 chairmen. First chairman was Sir Stuart Burgess. He was from the beginning till 2004. Then we had Ian Ivory for 4 years. And then he had for 14 years Martin as the chairman, 15 years on the board of directors. And on behalf of OrbiMed, I really want to thank you so much for your outstanding leadership, all your contribution, your guidance throughout your 15 years on the board of directors. Martin, you had a pretty tremendous influence on OrbiMed Advisors. For me as a firm, me personally, my team, and especially the Worldwide Healthcare Trust portfolio management team. And sign of a really remarkable leader is always someone who makes everyone around him better. Martin, you made us better. It's like you made us better portfolio managers. Without your guidance, with your stewardship, this run wouldn't have been possible. So this is quite a remarkable run. One of my favorite anecdotes of my time together with Martin, and I use this all the time actually right now. It's like we have a lot of analysts who've never seen a bear market. And I always give them a good anecdote from my time with Martin back in 2008 during the financial crisis. And this was in the fall of 2008. Many of you have been around. It was a terrible year. We thought the end of the world or the end of the financial market is coming. The fall was especially volatile, terrible performance across the stock market. Healthcare was really difficult. And we had a board meeting. And we were like holding our presentation, how dislocated is everything, how terrific are the values in healthcare, in biotechnology. And I'm walking out of the board meeting, I'm checking my Bloomberg, and I see another 5% down market, another horrendous day in the market. I'm standing there all upset. Martin comes over to me and he's like, Sven, what's wrong? It's like, why were you looking upset? And I'm like, Martin, it's been another catastrophe in the market, another 5% down. This is terrible. Feels like never ending. Martin goes really quiet. And I'm getting worried that he's starting to get disappointed in us, OrbiMed, that we are failing at portfolio manager. But Martin comes over to me and says, Sven, you know one thing? This is the investment opportunity of our lifetime. And this is exactly the point of time when Martin gave this sage advice. And let me tell you one thing. Back then, this was not consensus. Back then, everyone predicted the end of the financial markets is coming. And Martin almost called the bottom inside our sector. You know, I think healthcare actually, the bottom was set in December, January of this year, and then obviously market ended in 2009. But this was really interesting. All the PMs like myself, we couldn't see the forest for all the trees. You know, Martin, with all his experience, he could see it. This is a tremendous long-term opportunity. And Martin, look here, look at your legacy. You know, 15 years on the board of directors, 15 years of 15% rate of return. You know, with your stewardship, this wouldn't have been possible. So again, I think from Orbmet, and I can say as well from all the shareholders, thank you so much, Martin. You will be dearly missed, you know. And Doug, big shoes to fill, you know. All right, coming to our regular presentation here, Orbmet Public Equity team. I think you're all very familiar with all of them. You see myself, my co-portfolio manager Trevor on the top, together with our partners. Me and Trevor, we run this fund on a day-to-day basis, but with the help of the whole public equity team. This is not a two-man job. You know, you need to run this fund. You need all of the guys here on this page. Now, me and Trevor, we share all of our front-facing responsibilities, and Trevor promised next year he is going to be here. So at the next annual meeting, Trevor will come in instead of me to hold this presentation. You know, Orbmet, you know, had solid growth over the years. You know, it's an $18 billion organization. Slight pullback here during the bear market over the past year, but we have been very active and successful on the fundraising side, on the private equity side. Public equity is very strong. 1/3 of the organization is public equity, 2/3 is private equity. Worldwide Healthcare Trust, this is our flagship fund. This is the largest fund inside our organization, and you see here our sister fund, the Biotechnology Growth Trust. It's our second London Stock Exchange closed-end trust here in the UK. You know, you probably heard me always talking proudly about the number of people on our team. I always compare it to an arms race, you know, and this is the arms race Orbmet for sure is winning. We are outgunning all of the other healthcare portfolio managers out there. Nobody else has the size of the team dedicated to a single sector. Been very active in hiring, you know, 25 plus people over the past 2 years, 8 people on the public equity team side. And I think our talent on the scientific side is really unmatched. This is really what makes me proud and where I know I have all the tools to succeed in the future in place. Now, coming to the fiscal year, and you know, it hasn't been an easy one. You know, fiscal year ending 2021 was one of the best years in the history of the Worldwide Healthcare Trust. Everything worked, and then we followed it up with one of the worst years in our history. So last year, very, very challenging year, and obviously being down 5.8 while our benchmark was actually up 20% was very disappointing. So what happened? Well, it's a contrast between the 2 years. You know, what really worked in 2021 absolutely did not work in fiscal year 2020, did not work in fiscal year ending 2022. So in the previous fiscal years, fundamental investing really worked. Biotechnology was in the bull market. China healthcare worked extremely well. The IPO market was strong. Drug pricing, there was really on the back burner. We still had the tail end of a Republican administration in the White House. Small caps outperformed large cap stocks. There was a value into growth rotation, and taking risk and investing in innovative, high growth companies. That's what paid off. There were no big macro fears. And then we go into the last fiscal year. Fundamental investing did not matter last year. being in innovative, high-growth companies, that was the wrong call. If you were in an unprofitable company, you probably lost 70% of the value. There was no IPO window open. Drug pricing actually resurfaced, and there was a heavy rotation from growth into value. And everything, small and mid caps did not perform. Only the very largest mega cap companies performed during the year. And then you suddenly had all of the macro fears resurfacing. Russia invades Ukraine, interest rates rising, inflation fears increases. So it's like two mirror images, and that's what happened during the year. And here you see it in the numbers by subsector. And again, you look at the previous fiscal year, well, all subsectors were positive. Pharma, India, devices, services, Japan. But here, most importantly, the big contributions were in biotech, China, emerging markets, tools and diagnostics. These are like the sectors, super high growth, very high innovation, and many unprofitable companies. That's what drove that year performance. That's where we had significant alpha over our benchmark, the MSCI Healthcare Index. And then you come to the last fiscal year and you see the three red bars, biotech, China, and tools. Terrible, biotech cost us 11 points of performance. China and tools were over 300 basis points. And that's the explanation, those three red bars. That's the explanation why we underperformed vis-a-vis our benchmark, because we, as part of our fund manager, we really believe in the next big ideas, in the next big innovative companies. But for last fiscal years, that was the wrong call. Now here you see top 5 contributors, top 5 contractors. Same theme here. You saw the big winners, AbbVie, AstraZeneca, United Health, mega large cap companies. These are big constituents of the benchmark. If you were a large cap pharma and you're in large cap services names, you did just fine last year. But then you see on the loser sides, all biotech name, and then Guardant and Natera. Those are tools and diagnostics names. These are very innovative names, but they are not yet profitable. And these were the names that detracted. And if you look at top detractor, it's just full of biotech names, tools diagnostics, and a lot of Chinese emerging market names. Now, how has this year started? Well, April and May was a continuation of the last fiscal year. Especially May was another tough month. But I am hopeful that probably for the innovative high growth sectors, the bottom is in May 12th. Possibly, you see it here, was possibly the bottom in the sector. And you see here, June, the first spring blossoms. We had a very, very strong June, up 6.3%, far outperformed the MSCI. Month of July has started really well again. We are up 4% as of for the month of July as of last night. So for the year, we are like up 2%, and we are in line with the MSCI. So we made back all of the losses in the first 2 months of the fiscal year. So fingers crossed, hopeful that the valuations are in. And let me tell you why I do believe that the valuation lows are possibly in. So coming here to the investment themes. There are a couple of things why I think which are changing. Number one, I think all of the high growth innovative sectors which sold off so heavily, they are overdue for a rebound. The next part of it is that some of the overhangs are really lifting, and I will go in detail in them later on in the presentation, like USA, FDA, drug pricing, and M&A. So the combination of a reversion to the mean of the most beaten down sectors, together with the overhangs lifting, makes me comfortable that we have seen possibly a bottom in our sector. So here I'm looking at just the emerging biotechnology index. And this chart would look very similar if you would draw it for innovative small cap tools names, innovative small cap medical device names, or Chinese emerging market names would look very, very similar. And here you see the performance of the biotechnology sector versus the S&P 500. And this biotech bear market has set 3 records. Number one, the longest in duration. This is the longest biotechnology bear market in the history of the sector. The second one is the largest absolute drawdown, so minus 50%. This is bigger than we have seen at any point of time in biotech. And here, third, and most importantly, the largest relative. I've been in the sector for 30 years. I have never seen such a dramatic relative underperformance of the most promising healthcare names here inside the sector. So minus 67% versus the S&P, and this shows you how difficult it was over the past year. Now this is another interesting point that illustrates it. Here you see the gray bar. This is the mid-cap biotech companies. These are 1,000 biotechnology companies. This is the future of the healthcare industry, 1,000 of them. In February of last year, at the peak, their market capitalization was just barely bigger than J&J. Johnson & Johnson is the largest healthcare company in the world, has market capitalization back then of $440 billion. But the whole biotech sector was just equal to that one single company. And I would have made a point, hey, this looks cheap actually vis-a-vis J&J. Yeah? But now look at today. The market capitalization of those same companies decreased by 62%. It's a $190 billion market cap. Right now, all of the biotechnology companies are equal to the value of number 13 pharmaceutical companies, which is Bristol Myers. So this just shows you, and these pipelines, R&D pipelines, which are the lifeblood of the industry, is like multiples bigger than a Bristol Myers, multiples bigger than a J&J. But the market doesn't see it this way. The market thinks they should be valued too low. But this is a historic, I think, low relative valuation. This is another very important chart. This shows you biotechnology companies vis-a-vis their cash on their balance sheet. So this shows you how many companies are trading at below their cash balance on their balance sheet. So there are companies in biotech who have a market capitalization of $100 million and have $200 million cash in the bank. It's very common here right now. And the same thing, this is the number of companies trading below cash on the balance sheet. And now look at the history. The first spike, that's when the Nasdaq bubble burst in 2001. You want to see the financial crisis? That's the second spike. And here we have far superseding previous record set and during the financial crisis or when the Nasdaq bubble burst. Quite stunning. This is really stunning. And I do believe that this is a major dislocation, that the market is wrong how it values right now innovative companies. But this is another record low which we have never seen before in the history of this sector. Now I mentioned, the overhangs are slowly are lifting. Number one, we have a new FDA commissioner. He's terrific. Bob Califf, he got appointed. Finally, after a long wait, we have a new FDA commissioner in place. He's very industry friendly. He's very fair. And I think this is a tick in the box, major overhang lifted. Second part, US drug price reform. This has been in the front line for many, many years, starting 2015 with Hillary Clinton during her run for president. Even during the Donald Trump's 4 years, he always loved to talk about drug pricing. Now, as part of the Biden administration, they had a new legislation called Build Back Better. This was supposed to get signed off in November of last year, and part of that package is a piece of the drug pricing reform. But it was a compromise already, and it was extremely watered down. And the industry would have been gladly with signing off this part of drug pricing. Now then, Build Back Better faded off, but now it's back. And we know now over the next few weeks, if maybe another watered down compromise is coming back actually for election. But here's the important thing. Worst case scenario is we're getting this watered down drug pricing proposal. I think the industry would be really glad with this worst case scenario. Just getting drug pricing reform signed off and off the political agenda. Best case scenario is nothing happens, and we're going to get a split Congress in the United States, and then nothing will happen for a number of years of them. So me as a portfolio manager, I can live, and the industry can live with both scenarios. And the worst case scenario is actually a good outcome for the industry. And the other outcome, which I think is 50-50, is a terrific outcome. So drug pricing is as well fading into the horizon. And then number 3, and we have seen here as well a lot of spring blossoms here. We have seen a lot of M&A starting to pick up. And this is what we always see at the end of a bear market. The end of a bear market in the healthcare sector, you see a dramatic increase in M&A. And we're seeing it right now. In the fund, we had an acquisition of Turning Point by Bristol Myers, small biotechnology company, got acquired at 100% premium. We had another company is in Takeout Rumors by Merck. There have been Sierra acquired by Glaxo. You had Biohaven getting acquired by Pfizer. So in the past 6 weeks, the big pharma companies have started getting really active with M&A. And this is a trend which I believe will continue throughout the summer. So despite all of the macro disruptions here in the market, I think the bottom is set by the M&A activity by the big pharma companies, because they see that same chart, what I showed you before, how cheap biotechnology companies are. And for them, it's a half price sale. It's actually a 75% sale off, and they are active right now. Now, what are the next big things here? And this is where I will a little bit diverge. I'm not going to talk about just small biotechnology innovation. This is large cap innovation. This is big pharma innovation, because this is important to see as well. Innovation in our sector is everywhere. Even the biggest, largest pharma companies have tremendous innovation. And I will talk in particular about the oncology space, which has been one of the key drivers in our sector in the past few years. You had incredible new targeted therapies getting launched, many of them by our largest holding in the fund, AstraZeneca. Then you had cancer immunology compounds, became a multi-billion-dollar drug category, $30 billion for 2 drugs alone by Bristol Myers and Merck, Keytruda and Opdivo. And then here, a new drug compound really emerging called Enhertu, which is probably the most important drug in the hands of AstraZeneca, and we'll talk more about that. Another very interesting category, multi-billion-dollar opportunity, is diabetes and obesity. There's a new class of drug called GLP-1 inhibitors, and they are by Lilly and by Novo Nordisk. They're tremendous diabetes drugs, but they have a nice added side effect. You lose 20% of your body weight when you take those drugs. So they are incredible weight loss agents, which are extremely healthy as well, because they regulate your blood sugar as well. These are going to be 10, 20, $30 billion drug category easily, some of the biggest selling drugs here in the coming years. And then here, very controversial, Alzheimer's disease, but finally over the next year, we're going to see 3 major data readouts, one by Eisai, one by Roche, and one by Lilly. Today, actually, the FDA granted Eisai approval to file their drug based on phase 2 data, and they will make a decision by January of next year. But here, most importantly, we'll have major phase 3 data readouts in the fall. If you would ask me where's the highest chance of success, I would probably say Lilly, and that would be in the second quarter of next year. This is probably the highest drug risk category. I think it's a crapshoot, 50-50 chance that one of them will work. But if it does work, we will for sure talk about this at the next annual meeting. And we will know by next year if this category has worked. So here you see these are just three sectors with multi-billion-dollar opportunities. And these are areas where big pharma companies are extremely active. And let me talk a little bit about Enhertu. This is an ADAC, and a cancer compound, an antibody drug conjugate. This was originally developed by a portfolio holding, which is called Daiichi Sankyo in Japan. They licensed it out to AstraZeneca. It got first approval in 2019 as a third-line agent in breast cancer. And then last year, I had a major release of phase 3 data in a second-line setting against the industry leader, which is called a very efficacious drug called Casicla. But this year, you see Enhertu beat a very effective drug and reduced mortality risk of that by 72%. This was in high expressed HER2 breast cancer. And this year, you just had actually hot off the press here earlier in June, the phase 3 data in low HER2 against standard of therapy as well. This is not against placebo. This is against current treatment, a 50% reduction. You know, when this data was presented at the American Society of Clinical Oncology, this is where 40,000 oncologists goes, you know, every single year. There was a big plenary session, and for the first time, I've heard it only one time, the whole plenary session, 20,000 key opinion leaders in oncology stand up and clap their hands because they were so excited about the data. They think it's so transformative. This is going to be the next $15 billion drug. This is going to be the lifeblood of AstraZeneca for years to come. And it will move then from second line to front line setting, move into additional cancer indication like gastric, colon, lung. And this is a perfect example of a drug which becomes a multi-billion-dollar opportunity. So really, really exciting. And there are tons of examples like this inside our sector. And this is the reason, this is why you want to be invested in Worldwide Healthcare Trust, to capitalize on opportunities just like that, like an Enhertu inside AstraZeneca. So now coming to portfolio and positioning. So a couple of things here. You see here, we have structural underweights vis-a-vis our benchmark in large cap pharma. So we are 13 points underweight large cap pharma. Right now, it's a new underweight is in the tool space. We have those are two key underweights. The overweights vis-a-vis our sector is still in emerging markets, 10 points of exposure, even so we reduced a bit our exposure there, and it's in emerging biotech. So we are holding true to our relative overweights inside healthcare so that we are exposed to the fastest growth, most innovative sectors. And we have actively added here in the drawdown to our emerging biotech holding. We have actively added to some medical device names. There's some great high growth opportunities there. Some small cap names which had seen 70% sell-offs as well. So we added to those. And we have added a little bit actually to large cap pharmaceuticals. So it's not just price appreciation, but it's as well some new names there. On the leverage, we are at the moment at approximately 107% geared. We have some dry powder left. The upper end of the range is 120 points. This has come from 90s to 108% gearing. I could see that number going up into the mid-teens into the not foreseeable future. Now in here you see our portfolio, and maybe a couple of things worthwhile to highlight. Number one is our active share. So our active share here is close to 70%. So we are not a closet benchmarker. We are not an indexer. We're running this portfolio extremely actively. 70% of our portfolio diverge from the benchmark. It is a concentrated portfolio as well. The top 10 names contribute 45% of the portfolio. Top 30 names, 85% of the portfolio. You see a large number of names in some of the emerging market sectors, privates, and biotechnology. And the reason for it is these are small cap holdings. So we have a large tail of some of the smaller names in the innovative companies. But overall, the top 30 names, I think, is pretty concentrated inside the portfolio. And here, another question which we always get asked is like, what percent of the portfolio is in those unprofitable companies? So 75% of the portfolio is actually in companies which have a positive net income. So the unprofitable names are only 25% of the portfolio. So in summary, what's our playbook? I think we're sticking to our knittings. We do believe you want to be exposed to high growth, high innovation companies. We have repositioned the portfolio a bit in some of the most dislocated subsectors. We have added to the names which have been beaten down, which are down 75%. We do believe there will be a rebound is happening, that some of the overhangs which have been hurting the sectors are lifting. I think M&A is going to be a very, very important theme here, especially during the summer months. And as I mentioned before, we will use our gearing. We have dry powder on the sidelines, but overall, despite all the macro backdrop, despite all the recession fears, I feel positive about healthcare, and I feel very, very bullish about the outlook for the Worldwide Healthcare Trust. And with that, I would open it up to questions.